startup revolution was just about beginnings. It was still unproven. It was still not clear as to how exits would be generated. But there was a lot of energy. There was a lot of drive, hunger, entrepreneurship. And we thought that we could, we've done businesses ourselves, but we could play vicariously through founders that we fund because there was so much excitement out there.
Can we drill down a bit into ShipRocket as a case study? What made them a success? What are the pivots that they took that? And was it what you envisaged when you made the investment?
But as a company grows, you have to understand that roles change. So your role as a family office board member, what it is in early years, will change as the company grows, as the company scales. And that happens with all businesses. I think you have to also let go a little bit. Something that I would say family offices and operators find it harder to understand. Let me talk about one of our later investments that we did as a family office, and someone that I'm really excited about, which is Bombay Shaving Company.
Okay, now let's turn to external wealth advisors. What role do they play?
I think the whole ability to zoom out and think as a 30,000 level view is required. At the end of the day, we may pick an investment today that yields some results 2 years later, but frankly, we can only truly measure anything 10 years out or 20 years out.
Hello and welcome to Let's Mint Money, the show where we explore the attitudes towards money of India's leading business personalities. The show is presented in association with Waterfield Advisors. I'm your host, Neil Borate. Our guest today, Arihant Patni, is a seasoned entrepreneur, investor. He's invested in more than 100 startups. Some names that you might be familiar with are the Bombay Shaving Company or ShipRocket. In today's show, we'll explore his attitude towards investing, towards money, how he picks startups, and much more. Without further ado, welcome Arihant. So Arihant, you saw the story of Patni Computers unfolding. Can you give us some memories from that time?
Yeah, sure. In fact, Patni Computers was incorporated right around the time that I was born. So my memories probably go back to before even I can remember them. But as I was growing up, I saw a lot of the type A entrepreneurial approach that is common with successful startup founders. Business was always first. Business came home. There were arguments. There was ideation. My father and his brother started the business. One of the brothers used to live in the US and used to visit often. So a lot of that energy and that drive kind of really, came up. I must say that we were fortunate, earlier when we started the business, it was in the hardware space. And then, and that did well. And then we morphed to software in the run up to Y2K and thereafter went public and so on and so forth. So I say this all the time. I find myself very privileged to have seen a business go from inception, execution to exit over a period of 30 years. And I have a lot of gratitude that I've been able to go through that journey, both while seeing it happen growing up, as well as working in it later on. And then, of course, enjoy the proceeds of that after we sold. Yeah. I think one thing that really stood out during the early days as I was growing up is just the frugal approach which we took because we had to. We had to, make tough decisions and choices in terms of, how to expand business, what to expand and what not to. And I think that, again, is a very fundamental part of the early life of any business.
And in a sense, that helps you identify with the lives of startup founders, right? And their struggles.
Absolutely. I mean, it's interesting you say that. I think that's what a startup is. It's that chaos. It's that completely burning the midnight oil. I still associate startups, and having done some of my own, as a journey where you don't think of yourself. You're not thinking about a personal life, and you're just thinking about the business and what's right for the business.
All right. Let's now turn to your investments. If you can tell us about the investing principles that you follow.
Great. So it's a deep question, and I think it's also multi-layered. If I may, I'd like to break it up in two components. One is in my role as someone running the family office, which encompasses a larger scope, more investors in terms of my family. We're a close family office, so but they are my investors for whom I have to run the portfolio, and then my personal passion around early stage investing. So I think we were one of the early entrants into this, I would like to say, and thanks to my father's vision that traditionally most business owners and most entrepreneurs will manage their business proceeds through a corporate treasury or through someone in one of their companies. It's only recently where we've seen a spin out of a corporate treasury into its own family office, where there's a team that's actually looking after those funds and making sure that they've been invested wisely and with a certain discipline. So when we started the family office, now it's 20 years this year since we put it together, it was with the approach that we have created a certain amount of wealth through an operating business. We had some liquidity because of private equity investors and because of going public, which was with individual investors. So now how do we set this aside and grow this responsibly and grow this with a certain vision? So it was, if I may say so, a fairly evolved thesis that was instituted by my father and we as a family carried forward. And the idea here was that, look, while we have certain liquid assets, we have to try and figure out how we can work with them in the best way possible. I'd like to say some of this is like being a kid in a candy store, right? Now suddenly, and I see a lot of new gen family offices as well, where you have no bars, you have liquidity, and you can invest in anything from public, private, real estate, Bitcoin, art, you name it. I think our thesis was, how do we create a team? How do we create discipline? How do we create areas of strength where we feel we can do better than others, or do not even better than others, but do better for ourselves? So initially we started off looking at purely public markets. And then slowly, as the markets evolved, as the ecosystem evolved, we looked at private and other such alternate assets as well.
And what is the split now?
So I would say it's still largely public, but there's a private component in it as well. So I would say we're 70-30, 70 equity, 30 debt. And within the equity component, there's public and private. Again, as I said, mostly it is public, but a good allocation to private also. And with private, it is both direct as well as through funds.
Since public is a larger part, could you elaborate on your approach to the public market investments that you made?
Yeah, certainly. So initially, when we started out, and given that our team was small and we were still learning, most of our allocations were through managers, through mutual funds, as well as through portfolio managers, what in that time we called the PMS managers. And we did well with that. We picked well. It was also very tax efficient at the time. And this I'm saying when I say at the time, it was 05 through 015, around those 10, 12 years. Yeah. I think what happened a few years thereafter is, especially with the pandemic, with the sort of explosion of the private and venture ecosystem, and with the deepening of Indian markets, both public and private, there was suddenly a lot more opportunities that we needed to look at in order to outperform, let's say, the index or what have you. So after that, we had a change in guard, a new CIO, and we now look at purely direct investments through our desk. We invest directly in public markets. not so much through managers. But as I said, even for the alternate side, we do look at managers and work with them.
How do you approach investment decisions? Because there is a data approach, and then there is, with startups, the instinctive approach.
So I think on the first piece for public and for family office, it is largely data driven, of course. Again, our public market strategy is large and mid cap. It's not really into the small cap and illiquid side. I think from the startup standpoint and coming to the earlier kind of division I made, my hat as a early stage investor, angel investor, I think their data is limited. So it's more about the conviction, the team, and how you feel about the business.
Okay, so let's turn to your startup investments now. First, what pulled you? I mean, you've increased the allocation to it over the past 2 years, but what triggered it?
So, when we sold our operating business, of course, the family office became even more prominent. And this is back in 2011. At that time, the startup revolution was just about beginning, and early years. My brother and I were very excited about what was happening. And that's kind of what attracted us to this space. It was still unproven. It was still not clear as to how exits would be generated. But there was a lot of energy. There was a lot of, drive, hunger, entrepreneurship. And we thought that we could, we've done businesses ourselves, but we could play vicariously through founders that we fund because there was so much excitement out there. So that's how the journey started. And I think if you see from 2011 to 2025, let's say 15 years, I think we can see how much it's evolved, how much we've learned as a community, as an ecosystem of founders, investors, VCs, family offices. I think they've been learning across the board. Regulators, everyone has been sort of understanding what's happening and making whatever changes that they need to. So I think it was a natural progression. Even if we look at it internationally, there is most family offices globally will have a significant exposure to private equity and venture capital as a diversification to simply public markets. I often restrain myself from comparing the two because they are two different categories altogether. And happy to talk more about that, but it's not an apples to apples comparison. It's an apples to oranges comparison sometimes.
How so? Is it in terms of time horizon? Is it liquidity is the obvious one, but is there more to it?
Absolutely. So I think you said both. I think it is time horizon and liquidity. So I would say when we look at companies early stage and we find good founders and good businesses that have the fire and the capability to grow, I think taking a bet on that, taking some reasonable exposure could be very lucrative. But of course, one may have to wait 10, 15 years for it to actually play out. So I'll give you an example. One of our companies that we back through our fund, Nirvana, is I'm very proud of them, a company called Shiprocket. And the founders are exceptional people. We invested in them in 2014. It was a slightly different business model. They've pivoted when they've had to. They have innovated when they've had to. That journey was, of course, it is all to the credit of the founders and their hard work. But it's also great for us as investors and believers in them to see it play out. And it will be rewarding for everyone. So it's about patience, perseverance, and the ability to take a risk. I think the last thing we'd want, and this is where a lot of comparisons happen, is that you, out of just maybe the fear of missing out or what have you, you quickly invest in a couple of angel companies, expect them to grow very fast, and then suddenly compare that to how public markets have done 3 years for 3 years. And you say, it's not matched up because I don't have the returns, I don't have the liquidity. I just think that's where the apples and oranges come. I don't think that can be done. I think to make um, any meaningful comparison, you need a 30-year window, and we don't have that. So we're just about midway through that. So I think we'll have to have a bit more patience.
Can we drill down a bit into Shipped Rocket as a case study? What made them a success? What are the pivots that they took? And was it what you envisaged when you made the investment?
I think, and I'd like to talk about one other journey as well, but it is, as I said, a founder's business, right? The founders were very strong. They were basically building a platform for the internet economy. So initially they were, in the business of creating shop fronts for the brick and mortar small retailers, much like what Flipkart had at the time in a much larger scale. So helping sort of middle India go online, right? And I think that was fine. And there was a lot of energy around that. And then along the way, they also figured that aside from just having a shop front, you also need the entire back-end fulfillment piece in terms of logistics, shipping, warehousing, financing, so on and so forth. And that was also a pain point. So they were able to kind of think on their feet and create a great offering, which they had before, but sort of enlarge that offering. And that sort of really took off. Again, with the pandemic and with the explosion of internet, explosion of e-commerce in India, that kind of played into the story as well. So I think it was a mix of dedicated founders thinking smart, thinking on their feet, and also, like always, a little bit of luck, being at the right place at the right time. That kind of worked well for them.
Therefore, there is this hypothesis that family office capital is more patient, is what businesses possibly need more than a VC who expects so many times growth in next 5 years. Would you agree or not so much?
I think that family office is theoretically patient. Yes. I think that's easier said than done. It's just that as a VC, it is a business model for them as well. And as I said, you have a certain timeline. You have to send quarterly reports to your LPs. You have to show progress of your companies that you have invested in. So in that, there's an inherent expectation that there should be reporting, transparency, visibility. With that, there's also some expectation that there has to be growth. So, as a founder who's taken VC money should be ready for that, right? I mean, it's only to be expected. Of course, VCs also understand there can't be unlimited growth or growth in bad times or continuous growth without any flat quarter or flat year or whatever it is. I mean, we're all in businesses, right? So we understand that. But yes, there is that expectation that it has to be relayed to the LPs or who the actual investors are into a fund. As a family office, also I would say it is good behavior to have the same quarterly board meetings and the data and the engagement, because at the end of the day, you want to make sure that whoever owns a part of your company, or as a family office, whichever company you own a part of, you're involved in what's happening. From a patient standpoint, yes. I mean, you could say that as a family office, you want to be in a business or as long as the business needs it. And an example I'll give you is that, I funded a company now 7-8 years ago called the Math Company. They are in the business of providing data and analytics services to global corporations. Fantastic trajectory, fantastic team. They were fairly small when I first funded them. I was the only kind of investor, took a board seat. I would say they've gone 30x from there, and now quite a commendable player in this space. And I've been very engaged with them, and I like to call myself as part of that family. Now, as a family office, again, we have to realize that as a company grows, it will start. We got private equity investors into this company also 5 years later. But as a company grows, you have to understand that roles change. So your role as a family office board member, what it is in early years, will change as the company grows, as the company scales. And that happens with all businesses. I think you have to also let go a little bit. Something that I would say family offices and operators find it harder to understand, and let the team breathe and, spread its wings and fly. Because ultimately, it all comes back to, when it's successful, it all comes back to everyone.
So Arihant, can you take us through another one of your successful investments and what made them successful?
Let me switch to, I've talked a little bit about early stage and seeing that growth with Shiprocket and Math Company. But let me talk about one of our later investments that we did as a family office, and someone that I'm really excited about, which is Bombay Shaving Company. So Shantanu Deshpande is a great founder. He's also an active person on podcasts and so on and so forth. So I'd say I'm taking inspiration from him to be on this. But, again, we came in about 3 or 4 years ago. The company had already scaled up quite well, and, was creating a dent in a very traditional market.
At what stage did you come in? How many years had they been in operation?
They had already been in operation for, I want to say, 7-8 years. They had a good, steady trajectory revenue-wise. This was, mind you, also in the heydays of D2C. It was around 2021 or thereabouts. And they've done well. And I think it's been very interesting to work as a family office. And I must commend my CIO as well, to work closely with the team there in terms of them raising follow-on rounds of capital, in terms of strategy for growth, in terms of numbers now turning EBITDA positive. They're in the middle of breezing around, and soon. I hope that they will go public one day. And I think this is a caliber of entrepreneur which has been very interesting to work with. Great ideas, great innovation, clearly makes them known as well. And the company also embodies a lot of that. So very proud for what they've done. And as we progress on this journey, I will, I'm really hopeful that it turns out well for everyone.
So as a later stage investment, is it easier for you to make that decision because you've seen the business model established and working? On the other hand, the price is also higher.
Yes, it's a great question. And I think that if we were to look at the market today, there's lots of activity in early stage, in angel and seed stage. There's a lot of competition as well. But there, if you get it right, the kind of multiples you get are enormous. I think there's still a lot of activity in Series A and A plus and so on and so forth. But this area of growth, Series B, is interesting because I think there the companies are, still figuring it out while they've got great metrics and all of that. And at the same time, I would say capital is also little constrained. And I think family offices could play a great role there. So again, for a family office to come in and say, okay, you know what, I've seen what this founder has done over the past maybe 5, 7, 8, 10 years. I've seen the conviction. I've seen the drive. And, we think that this business has value. We have numbers. We have metrics. We have customer experience. We have, all of that data. So do we think that this is a good story going forward for an additional 5, 10 years? And I think that's super interesting because you get founders that are ready to take it till the end, that are already experienced, super passionate, and it's a lot of fun. I think the one thing you want to definitely test there is, are your financial metrics in place? Because if after 10 years, it's not worked out, then what are the reasons, right? I mean, those are very important. And is the founder as passionate and energetic as he or she was in day one?
Because honeymoon is over.
The honeymoon's over. And if the founder is looking to exit, then that's a problem, right? But there are a lot of stories like this because realistically, businesses take time to create and mature.
Yeah.
So I started this conversation with my family business, which is a 30, 40-year journey. Even though technology and AI has accelerated things, I still think that a business journey or a business creation cycle is still fairly long. It's at least 15 years.
Okay, now let's turn to external wealth advisors. What role do they play?
I think the whole ability to zoom out and think as a 30,000 level view is required. At the end of the day, we may pick an investment today that yields some results 2 years later, but frankly, we can only truly measure anything 10 years out or 20 years out. And then again, you distill down to, okay, what are the means by which we can achieve our goals? So today, if your goal is to compound at 50%, an absurd number, then you kind of build those the trajectory towards that. I don't recommend it, but I think also having reasonable goals in terms of what can be achieved in a responsible way is incredibly important. So someone should be able to guide on those aspects. And then the investments are a kind of feature to feed into that overall thesis.
When people think about legacy, they often think about philanthropy, building libraries, building something that the name survives, maybe for hundreds of years.
Yeah.
Is that the only route to legacy, or is it also businesses that survive that long? How do you think about it for your own legacy?
I think it's both, yeah. And if I may say, I admittedly, again, admitting knowing what you don't know, I'm 49, so I'm a little bit, a few years to go till I get there. So I haven't quite formulated what legacy means to me. I'm still in the thick of things and honestly doing things that I believe in. Generally, if you see it from a wider landscape, it means all of it. It means creating an institution where your name is not necessarily attached on a day-to-day basis, but it's still thriving, or it's building, ways of serving community, and all of those things.
All right. Finally, if you could pass on one idea of money to the next generation, what would that be?
You're asking a person from a type A Marwadi business family to advise on money. So just genetically, I'm constrained because I have to say that, making money and creating wealth creates value and allows you to do greater things and serve a greater purpose. But I will say this against the grain of my DNA, that not everything is done for money. And I would say not only money, I would say recognition. Sometimes you do things that work well financially, where you may or may not be recognized immediately, but are very fulfilling to you. And I think, angel investing sometimes is like that, right? I mean, you're not the operator, you're not on the front lines. If the business fails, you take the financial setback. If the business succeeds, yes, you get the financial earning, but a lot of the recognition goes to the founders, as it should.
Yeah.
So you're sort of on the sidelines, and yet you're kind of gaining from it. So
you're watching the plant grow.
You're watching the plant grow. Exactly. That's well put. So I would say that should also be the humility is what we should have, where we don't need to be out there and front and central all the time. Good things happen even without us doing that, right?
Arihant, thank you so much.
No, thank you for having me.
Thank you so much for watching Let's Mint Money. If you have any feedback about family offices or any questions, Please put them in the comments to this video and stay tuned for the next episode.